Imagine you own a massive chunk of a highly successful business, like a really successful one.
We're talking a complete cash cow, right?
Oh, absolutely, a total gold mine. And imagine that depending entirely on a rigid, honestly kind of outdated set of rules, the way you report that success to the world, well, it changes completely.
It's a fascinating thought experiment, and it happens every single day.
Yeah, exactly. Welcome to the hidden high-stakes world of financial reporting. It's a space where compliance can actually actively obscure the economic truth.
Which is wild when
Yeah.
you think about it. We rely on these financial statements to be the absolute bedrock of the market.
Right. And today's deep dive is all about a specific document that is trying to rewrite those rules. We are looking at how companies value their massive investments.
Specifically, we're looking at a really detailed comment letter submitted by GAAP Advisors.
Authored by CA Manish C. Iyer.
Yeah, Manish C. Iyer, who's a director there.
Huh.
And he submitted this letter straight to the International Accounting Standards Board, the IASB.
And he is responding to their exposure draft on proposed amendments to IAS 28, which, for you listening, is all about the fair value option.
It's a very technical space, but the implications are just, they are massive.
So why should you care about some technical accounting standard, right? I mean, it sounds dry.
On the surface, maybe.
Okay.
But the way companies measure these investments directly impacts the profit and loss statements that you read every day.
Exactly. It impacts the health of the markets you interact with. It basically dictates the core narrative of global business.
To really get why GAAP Advisors is pushing back so hard, we need to lay down the baseline. What exactly is IAS 28?
Right, let's unpack this. It deals with investments in associates and joint ventures, correct?
Correct. So think about a situation where a company holds a significant chunk of another business, like, 20 to 50%.
So you have significant influence, but you don't outright own the thing.
Exactly. You have a seat at the board table, but you can't just dictate everything. And typically for these investments, companies are forced to use something called the equity method.
Which is historically, well, kind of clunky.
Extremely clunky. It's based on historical costs. You record the initial cost and then slowly adjust it based on your share of their profits over time.
So if that company you invested in suddenly doubles in value on the stock market.
The equity method doesn't care. It completely ignores that real-time market value.
Wow. Okay, but there is an exception, right? A carve out.
Yeah, there's a fair value option. And who gets to use that option is exactly the massive debate GAAP Advisors is jumping into here.
Because right now, the IASB is having a bit of an identity crisis with this rule.
They really are. Before we get into Manish C. Iyer's radical solution, we have to look at the flawed system they are trying to fix in paragraphs 18 and 19.
Right, so the current exposure draft is proposing an amendment. As it stands, the rules say that specific entities get a special pass.
Specifically, venture capital organizations, mutual funds, unit trusts, and investment-linked insurance funds.
Okay, so if you are one of those, you get to bypass the slow equity method and use the fair value option under IFRS 9.
Yeah, you get to mark your investments to market reality.
But wait, why? Why do venture capitalists and mutual funds get this special privilege while, say, a regular tech company doesn't?
Well, historically, the logic was that for an investment fund, their entire economic reality, their whole business model, is predicated on capital appreciation.
Right. If a mutual fund used the lagging equity method, their net asset value would be totally divorced from reality.
Exactly. Their investors demand to know what the portfolio is worth today, not what it historically earned.
Okay, makes sense for them. But the IASB is trying to clarify this, right, by linking it to IFRS 18.
They are. They want to say these similar entities are strictly those whose main business activity is investing in specific assets.
And here's where GAAP Advisors swoops in with their first major critique.
Yeah, they say, well, we partially agree with the direction, but you have a massive flaw in how you're writing this.
Which is what? Exactly.
GAAP Advisors points out that the current rules literally list out all these entity types, like mutual funds, but they completely fail to actually define them anywhere in the IFRS standards.
Wait, really? They just use the terms and assume everyone knows what they mean?
Yes. Out of all the entities listed, GAAP Advisors notes that only investment-linked insurance funds has a clarifying example in the text.
That is wild. It's like an office sending out a memo saying the dress code is business casual, but refusing to define what that means.
That's a perfect analogy.
Someone shows up in a blazer, someone else shows up in a polo and khakis. It's totally subjective.
And in accounting, subjectivity leads to what they call diversity in practice, which is exactly what GAAP Advisors is warning the IASB about here.
Because if a company in Singapore interprets mutual fund differently than a company in Frankfurt, the financial statements aren't comparable anymore.
which defeats the entire purpose of international standards.
So how does GAAP Advisors suggest fixing this? Do they want the IASB to just sit down and write a dictionary of definitions?
Actually, no. They argue that trying to write rigid definitions for all these entities across all the standards it would take way too much time.
Because finance moves too fast, right? Wall Street would just invent a new fund type tomorrow.
Exactly. So their proposed fix is actually brilliantly simple. Scrap the specific names entirely.
Just delete the words mutual fund and venture capital from the rule book.
Yep, just use a purely functional definition. The rule should say the option is for any entity having main business activity of investing in particular type of assets.
Wow, so it doesn't matter what you call yourself on your letterhead, it only matters what you actually do.
Right. It future-proofs the standard and eliminates the confusion all at once.
Okay, so that fixes the who gets to use the rule. But GAAP Advisors doesn't stop there, do they?
Not at all. Once they point out the flaw in the classification, they take aim at the rule itself, the equity method.
And this is where it gets into a bit of an existential crisis for the accounting world.
It really does. GAAP Advisors makes this surprisingly bold, almost philosophical point. They explicitly state in the letter that the conceptual basis for measuring investments via the equity method, well, they say it is not clear.
Which is kind of shocking to hear, right? I mean, this is a cornerstone accounting method.
It is. And what's fascinating here is that they're exposing a deep-seated confusion in the profession. Is the equity method a true measurement method?
Meaning, is it actually trying to tell you what the asset is worth?
Right, because if it is, it's doing a terrible job since it ignores market value entirely.
Or, and I think this is the other side of the debate, is it just a one-line consolidation method?
Yeah, exactly. It's just a mechanical shortcut to compress a company's financials into a single line item because you don't fully control them.
And GAAP Advisors is saying, hey, standard setters, you've never actually made this clear.
They haven't.
Yeah.
And GAAP Advisors points out that this lack of clarity is a massive immediate problem right now because of IFRS 18.
Ah, right. IFRS 18 is the new presentation standard shaking everything up.
It is. IFRS 18 requires all companies to strictly pigeonhole their income and expenses into distinct categories: operating, investing, and financing.
Okay, and where does the equity method fall into that?
Under IFRS 18, anything accounted for under the equity method gets forced into the investing category, period.
Wait, regardless of what the actual business relationship is?
Regardless.
Okay, let's play this out for the listener because the implications here are huge. Imagine a massive car manufacturer that is pivoting to electric vehicles.
Okay, very realistic scenario right now.
So they don't just passively buy stock in a battery maker hoping to make a quick buck. They buy a 30% strategic stake in a battery plant to guarantee their supply chain.
Right. They're putting engineers on the ground. It's totally integrated into their core operations.
But because it's only 30%, they are forced to use the equity method.
And because they use the equity method, IFRS 18 forces them to take all the profit from that critical battery partnership and bury it down in the investing section of their income statement.
Pulling it completely out of their operating profit, that completely distorts the narrative of how their actual business is performing.
It's a presentation disaster. It makes strategic partnerships look like passive side bets.
So because the equity method is conceptually murky and causes this IFRS 18 nightmare, GAAP Advisors drops a total bombshell recommendation.
They do, they say. Democratize the fair value option. Open it up to everyone.
Not just investment funds.
Not just funds. Allow the car manufacturer to use it. Allow a tech conglomerate to use it. But, and this is crucial, they add one massive, non-negotiable limitation.
Right. They don't just want a free-for-all.
No, the fair value must be strictly level 1 in the fair value hierarchy.
Okay, here's where it gets really interesting. What exactly is a level 1 input?
So IFRS 13 defines how we measure fair value, and it uses a hierarchy based on how reliable the inputs are. Level 3 is at the bottom.
Let me guess. Level 3 is basically management guessing.
Pretty much. They call them unobservable inputs. You build a complex internal model, you guess at discount rates. It's very prone to manipulation. Think Enron.
Yeah, that's the stuff auditors have nightmares about. What about level 2?
Level 2 is better. It uses observable inputs like looking at the recent sale of a similar property down the street, but it still requires some adjustments.
Which brings us to the top, level 1.
Level 1 is the absolute gold standard. The text defines it strictly as quoted prices, unadjusted, in active markets for identical assets that the entity can access at the measurement date.
So an analogy here. Level 1 is like valuing your Apple stock. You just open an app on your phone and you see the exact undeniable public price that thousands of people are trading at right this second.
Exactly. There is zero guesswork, zero room for fraud. You literally just multiply the share price by the number of shares you own.
That's brilliant. So GAAP Advisors is telling the IASB, you're scared of letting regular companies use fair value because you're scared of level 3 manipulation.
Right, but if you restrict it entirely to level 1, that fear completely vanishes.
Because if a non-investing company holds a joint venture that happens to be publicly traded, why shouldn't they be allowed to use its undeniable market value?
There's no logical reason to deny them that truth. And GAAP Advisors points out the massive benefit to this, specifically tying back to IFRS 18.
Oh, right. The operating versus investing shift.
Exactly. If that car company's battery partner happens to be publicly traded, and they can use the level 1 fair value option.
Then they aren't trapped in the equity method anymore.
And because they aren't in the equity method, IFRS 18 allows them to present the income and expense from that strategic investment in the operating category.
Wow. So they finally get to show the market the true operational health of their supply chain. It fixes the presentation glitch entirely.
It aligns the accounting with the actual economic reality. It's a huge strategic win.
Okay, so GAAP Advisors wants to expand who can use the rule and how they use it. But now they tackle when they can use it.
Yeah, the timing mechanics. And this is where they expose what is arguably the most frustrating trap in the current rules.
The initial recognition trap. Let's dig into this. What does the current standard actually say?
Paragraph 18 currently says an entity must elect the fair value option at the initial recognition of the associate or joint venture.
Meaning day one, the day you buy the shares.
Day one. You pick a lane on day one, and you are permanently stuck in it for the entire life of the investment.
And GAAP Advisors strongly disagrees with this rigidity, right?
They push back incredibly hard. Their argument is essentially reality changes, so the rules need to be able to change too.
Right. A company might start or stop a main investing business.
Exactly. And more importantly, tying back to their level 1 argument, those public market prices might suddenly become available later, or they might disappear.
Let's bring in a real-world scenario so you, the listener, can really feel the pain of this rule.
Let's do it.
Imagine a massive pharmaceutical company. They buy a 30% stake in a small, totally private biotech startup.
Okay, so on day 1, initial recognition, that startup is private. There is no active market.
Which means no level 1 input is available.
Right, so they are legally forced to choose the equity method. They have no choice.
Okay, now fast forward 5 years. That little biotech startup cures a disease and goes public with a massive IPO.
Suddenly, it's trading on the New York Stock Exchange. A level 1 input is now instantly available.
Everybody in the world knows that 30% stake is now worth billions of dollars. But under the old IAS 28 rules...
You are totally stuck.
Yeah.
Because you couldn't elect fair value on day 1. You are permanently trapped using the equity method.
So your balance sheet continues to show this tiny historical fraction of profits, completely ignoring the billions of dollars of market value sitting right in front of you.
It makes the financial statements look like a total fiction. If we connect this to the bigger picture, GAAP Advisors is demanding that accounting standards stop acting like a static time capsule.
Right. Businesses evolve, investments evolve. The accounting has to be dynamic enough to reflect that.
And they don't just complain about it. They actually provide the IASB with the exact blueprint for how these new rules should work.
I love when comment letters do the heavy lifting. Let's break down the specific triggers GAAP Advisors proposes for turning the fair value option on and off F.
Okay, let's start with turning it on. They call this commencement.
So when are you allowed to switch from the equity method to fair value?
They propose 2 distinct conditions. First, if you actually commence a main business activity of investing.
So if a company spins up a dedicated venture arm.
Exactly. Or the second condition, a level 1 input for that investment suddenly becomes available.
Which is our IPO scenario.
Yes. Notice it's an OR condition. You only need one of those things to happen to unlock the fair value option.
But turning it off is a completely different story, isn't it?
It is. The friction they build into turning it off, the cessation triggers, is really telling.
They use an and-D condition here.
Right. You must stop using fair value and go back to the equity method only when both of these happen. First, you cease the main business activity of investing.
And
level 1 inputs are no longer available.
so wait, If a company shuts down its venture capital arm, but the stock they hold is still publicly traded, they still have a level 1 price GAAP advisors. Says they get to keep using fair value.
Exactly, because GAAP Advisors believes that level 1 market truth is inherently superior. If the public price is there, use it. You only get forced back to the equity method if the asset gets taken private and you stop being an investor.
That is a fascinating philosophical stance. Market truth over corporate structure.
It really is. Now, let's deep dive into the actual mechanics of these switches, because GAAP Advisors proposes very specific insertions for paragraphs 18A and 18B.
Right, because switching accounting methods on a multi-billion-dollar asset isn't just a paperwork exercise. It drastically changes the math.
Massively. Let's look at switching TO fair value first. Our biotech startup just had its IPO. What happens to the balance sheet?
Under GAAP Advisor's proposal, you take the difference between the old, clunky equity method carrying amount,
Let's say it was valued at $50 million on the books.
and you compare it to the new real-time level 1 fair value. Let's say that's $2 billion.
The standard says that massive difference, $1.95 billion, is recognized immediately in profit or loss.
On that exact day.
Yes, instantly.
So what does this all mean for the listener? Imagine the immense pressure and strategy involved for CFOs here.
Oh, it becomes a massive strategic lever.
You're talking about managing transition moments where hundreds of millions or billions of dollars in profit could be recognized in a single quarter simply because a level 1 trigger was hit.
CFOs would be highly incentivized to track and perhaps even time these market events to manage their earnings narrative. It's incredibly high stakes.
Okay, but what about the reverse? Switching away from fair value. Say a company gets taken private by a private equity firm, so you lose your level 1 input.
GAAP Advisors provides a really clean solution here. They say the fair value on the exact date you cease the option gets locked in.
It essentially freezes.
Right, it freezes. And that frozen number becomes the new deemed cost for the equity method going forward.
So you don't have to retroactively try to calculate what the equity method would have been for the last 5 years.
No, that would be a nightmare. You'd just draw a line in the sand with the final public price, call it your new base cost, and start applying the equity method adjustments from that point onward.
That is surprisingly pragmatic for an accounting standard.
Manish C. Iyer really thought through the operational reality of applying this.
Speaking of messy operational realities, as we start to wrap up this technical rewrite, we have to look at how this works in complex corporate structures.
Yes, the partial holding puzzle. This is where it gets really convoluted.
Because in the real world, massive conglomerates don't just hold assets in a simple direct line.
No, they have subsidiaries and shell companies and dedicated venture arms all tangling together.
So GAAP Advisors proposes an amendment to paragraph 19 to deal with this. Let's set up an example. Say a parent company, a huge telecom giant, holds a 20% total stake in a satellite startup, but they split it. 10% is held indirectly through their dedicated venture capital arm and investing entity. The other 10% is held directly by the operating telecom parent.
This is a classic accounting headache. Under the old rules, standardizing this was a mess.
So how does GAAP Advisors resolve it?
They suggest that the portion held by the investing entity, the venture arm, can absolutely use the fair value option.
Because it meets the functional definition we talked about earlier.
Exactly. But the remaining portion, the 10% held directly by the operating parent, must use the equity method.
Okay, so they bifurcate the accounting. Half at fair value, half at equity method.
UNLA is, and this is the master stroke that ties their entire thesis together.
Yeah.
Unless level 1 inputs are available for that satellite investment.
Wow, so if that startup is publicly traded, it overrides the corporate structure completely.
Yes. GAAP Advisor says, look, if there's a level 1 market price, just use it for the whole 20%. Don't force half of it into the equity method just because of which subsidiary technically owns the shares.
Objective truth wins out over legal plumbing.
Exactly. It's perfectly consistent with their core philosophy.
Okay, so that covers the mechanics. But there's one final logistical piece here, transitioning to question 2 of the exposure draft.
Right, the effective date. Because you can't just drop these massive changes on the global market on a random Tuesday.
Right, the IASB proposed applying these amendments to IAS 28 at the exact same time and on the exact same basis as the new IFRS 18 standard goes into effect.
And GAAP Advisors completely 100% agrees with this proposal.
Why is that synchronization so vital? Why not phase them in?
Because if you phase them in, you create a period of total chaos.
Because of the operating versus investing presentation shift we talked about.
Yes. Imagine if IFRS 18 goes live, forcing all equity method investments into the investing category, depressing everyone's operating profits.
And then a year later, the IAS 28 amendments kick in, allowing companies to use level 1 fair value and suddenly move all those assets back into the operating category.
The year-over-year comparability of the financial statements would be totally destroyed.
Yeah.
Analysts would be pulling their hair out trying to model it.
So you have to do a big bang transition, change the measurement rules and the presentation rules on the exact same day.
It's the only way to maintain the integrity of the market data.
So, stepping back from all the technical jargon, let's summarize the incredible journey of this deep dive.
It really is a journey.
Because what started as, a dry 5-page comment letter on IAS 28 from GAAP Advisors.
It turned out to be a profound philosophical debate about truth in corporate valuation.
Absolutely. We watched GAAP Advisors systematically advocate for scrapping vague labels like mutual fund in favor of functional reality.
They boldly questioned the conceptual basis of legacy methods like the equity method, pointing out that no one really knows if it's a measurement or just a consolidation shortcut.
And they aggressively demanded that objective reality, specifically level 1 inputs, should be available to everyone, democratizing the fair value option.
And finally, they built a dynamic framework so that financial reporting can adapt as businesses evolve, rather than trapping them in initial recognition time capsules.
It's a masterclass in accounting theory meeting operational reality.
But it leaves us with a really massive question.
I was hoping you'd bring this up. I want to leave the listener with a final provocative thought to mull over.
Well, think about this. If GAAP Advisors is right, and their logic is incredibly sound, if the equity method is conceptually unclear compared to the undeniable truth of a level 1 active market price,
Yeah.
are we slowly moving toward a future where all historical accounting methods are abandoned?
Oh, wow.
As global markets become hyper-connected and entirely liquid, right? We have secondary markets, tokenization, real-time pricing for almost everything.
So you're saying eventually everything might have a level 1 equivalent,
Exactly. Will every asset eventually be measured by its real-time fair value?
which would render traditional historical balance sheets completely obsolete. You wouldn't have carrying costs, you just have a live ticker of enterprise value.
It would fundamentally change the definition of what a financial statement even is.
That is a staggering thought, and it's exactly why we do these deep dives. To all of you listening, we invite you to look at the financial news tomorrow with a totally different perspective. When you see a massive joint venture announced, ask yourself, how are they actually measuring that truth? Thank you for joining us.